Hello, everyone, and welcome to another episode of Flipping Out. This is your host, Paul Lizell. Today with me is Charles Carillo. And Charles, I've had other multifamily people on before. Charles specializes in multifamily, and that's all he really is focused on right now. But we're going to talk a little bit about because I know he's done small multifamily. He's also done the bigger ones. He's going to talk about some of the differences between the two, which there is definitely a lot of. I do some of the small multifamily. He's going to talk more about 40 units compared to 3,000 units and things like that. Charles, before we jump into that and dive into those questions, I know your background is also you co-founded an online processing company that processed over 1 billion in payments for clients of 5 different continents. Why don't you talk a little bit about your background there and a little tiny bit about that, and then what led you to get into multifamily?
Yeah, so I've been involved in multifamily as an investor since 2006. My dad has been an investor in multifamily since 1984. So I grew up and my dad owned a lot of smaller 3, 6, 12 unit, even 18 unit properties. And in no syndication, it was just him and one partner on most of them. And they were not great properties. They were D's and C's. And it was something that they were just like terrible. It was a terrible thing. And I never really wanted any part of it. And then in college, I really got bit by a bug. I would say high school, college. So when I got out, I bought a 3 family, and it was my dad made sure it was in a better area, and that was one thing he always stressed the area whenever I bring up a property. And I kind of wish I'd bought in better than that when I look back in retrospect, because those are the ones that really appreciate more. Your poor properties don't really appreciate much, and that's like in any market. And then I did another 3 family, and then I did a 5 unit mixed use, which is where you had like an office on the first floor and some apartments above it, and all this stuff between 2006, 2010, and then 2012. And I self-managed for 6 years. In 2012, I moved down to Florida, and I put professional third-party management in there. And I ended up selling that portfolio of properties in 2022 to an investor out of New York City. So these were all in Connecticut, where I'm originally from. So that's where I really started on small stuff. Since being down here in Florida, I've really focused on larger properties with our partners, and it's really we started our small syndication. Our first one was 59 units, and then our last one was 536 units. So over the last few years, we've done kind of a whole realm of them. And right now, I would think our main strategy criteria is really 100 plus units on properties, and we really like the Southeast, mainly parts of Texas, outside of Greater Atlanta, and then what we say the I-4 corridor in Florida, which is all the way from Jacksonville to Tampa. So those are where we really focus on properties right now.
And those are great markets. Those are
Yeah,
definitely markets I focus on too on my side with real estate. And
yeah,
it's where you look at it where people are going, right? Where people
yeah.
are migrating to, where are the rent's going to go up the most, where does it look best for the future? Plus zero income
Jobs.
tax
Yeah,
states, a couple of them too, right? And jobs, right? Good
yeah. Jobs are
employment,
big in those areas. Yeah,
huge, especially in Texas now. Well, let's actually talk a little bit about this because this is not something that a lot of investors talk about here, but I think is important because it changes cash flow. Your difference in taxes, real estate taxes between Florida. I know Texas is very high in real estate
yeah.
taxes because that's how they fund everything. Talk a little bit about that. Is there a substantial difference between any of the states that you're investing in taxes?
There, obviously, you're going to see a much lower property tax in most. We're talking about most Southeast states. I'm from Connecticut, so property taxes are still higher in
Yes.
Connecticut than they are in Florida, which is just insane. I moved down here, people are like, "Oh, it's like 1.5% is your property tax down here," and I was like, "That's nothing, man. We're paying 2% up there. Plus, we got to pay this, that, and the other thing." But let's talk where we're really investing in the Southeast, where there's growth in the United States, right? So Sun Belt, and so in the Southeast, mainly you are Texas has, yes, the high property taxes. Texas also has higher property taxes than really Florida when you're looking at it, overall. And then they also have much higher sales tax too. It's like a
Mm.
couple percent higher, which but say, oh, what do I care about that? Well, you have people living there, and you got to buy stuff. You know what I mean? And so you're maintaining the properties. You have to pay sales tax and stuff like this. So those are the taxes you're really looking at. The income tax portion is great. If you are a high income earner, then it all works out for you. If not, then it doesn't work out as much. But for other properties, we have property in like Oklahoma, and property taxes are less there. And in Florida, they're a little bit less. Florida, we have the other end of it, which is the
Mhm.
insurance, right?
Yes.
And it's just one more thing you have to add on there.
Mhm.
And Texas has that too. If you go down to Houston, it used to be 350 a door per year, right? Per unit a year for insurance years back, right? And then in like 2018, 2019, they had that hurricane and everything just went crazy. And now you're like $1,000 plus, right? And it was down in Florida, it's just we've really had this jump up in the last 12 months on property taxes. It
Yeah.
really hit a lot of single family people, people that own their own homes, homeowners, let me say. And investors it has, but it's also you can you have much bigger insurance
Yes.
premiums with larger properties. There's a lot more flexibility you would have there versus if you're a homeowner and it goes from $3,500 to $6,000 a year, and you have an independent agent searching all these places, and that's it. I mean, you know what I mean? It's just a lot of people have pulled out of the market. Insurers lost a lot of money years back between a lot of fraudulent roof claims down here. So Florida's a difficult place. Every place has their pros and cons to why people are there investing. And it's really, that's one thing we love about Georgia. Georgia really there's not that much
Mhm.
risk of any type of greater Atlanta, that much risk of like storms on that end of it. So your insurance is staying pretty relatively, everybody's insurance has gone up in the last years. You know what I mean? I had properties in Connecticut before I sold them last year that went up 10%. So, there's still increases everywhere in the United States, and that's a lot of inflation that hasn't been really accounted into a lot of premiums for years. But I think that, you just have to know when you're going into a new market, when you're underwriting stuff. And the big things when we're looking at it, it's really insurance and it's really taxes. Those are the big ones because no matter what your debt structure is, you still have to pay those.
Right. No, it's so true. And insurance is a big thing. And you made a great point. A lot of people are, and I'm still complaining too, the insurance is going up. But I realize over the years that it has not gone up with the rate of inflation. With what it costs to renovate and repair these properties is much more than it was 3, 4 years ago, pre-COVID times, right? Labor is a lot more. All the materials went through the roof. So we have a lot more to pay, and they're trying to play catch up, right?
Yeah.
Is what they're trying to do. So we're going to have that. Florida has gotten hit. I'm noticed it with the single family, and same with flood insurance in different areas as well. But
Yeah.
Atlanta is another great spot, another great market. Like you said, way less risk. They're going to get tropical storms, not the hurricanes so much because they're far enough inland. They're not going to have the same issues. They aren't going to have the same kind of wind insurance or anything like that. And again, a really growing market. I think Georgia is one of the most underrated and utilized by a lot of investors
Yeah.
out there. They look at, it's sexy to look at Arizona, it's sexy to look at Texas and Florida. And, the Carolinas were ignored for years. Now
Yeah.
Carolinas really getting more popular, and Georgia as well,
Yeah.
especially for these multis. So, I mean, there's a great markets when you get into. I want to talk a little bit about what makes you look at a particular property. We can talk about the different classes, C class, B class, A class, all those things. Is there anything you look at as far as demographics? Obviously, you're looking at a market that has people moving to it, not from it. But are there any different things that you look at factor wise, demographically?
Yeah, so there's a few things that we look at. Number one, and it's easy to look, is population, and that's but population is great, and that's just one factor of it. The other part I would say is job growth, which is a little harder to dig into it. Job growth slash diversity. So you have job diversity. So you're having. I don't want everything. I don't want to be buying something in property, and 25% of the people are with a military base that's right there. You know what I mean? Or with in Florida, we had the big issue back in '08, which I don't know if you're down here, Paul, for that. I was not. And that was construction based. Everyone was in the trades down here. So when that went down, unless you were buying like used tools from pawn shops, I mean, you were out of business. There was nothing else to do. And I had people coming to Connecticut to rent that used to be in the trades in Florida to rent apartments up there. And they were living down where you are. I had someone that had like a $500,000 house in like Cape Coral, and they came up to rent it in $695 2-1
Wow.
in one of my properties. So people got really hit hard during that time. And not saying that's going to happen this time through. It might happen in 10 years from now. But the thing though is that what we really found with it is that if you do the checking on the jobs, you're checking on job diversity, and then also another thing I like looking on is crime. And
Mm,
I always, when I'm running these numbers, it's not over like a year or two; it's over like 20 years,
yeah.
and you can easily do it. And it's not going to be perfect. Everything's not going to be perfect, but just that you see crime is decreasing consistently, and you can see like a line going down over 20 years. Same thing with population and jobs, they're going up. And with the crime, why it's so important is for obvious. But the other thing too is that when you see a consistent decrease in crime, it is much harder to fake. And it's also something you can't just like lock up everybody in one town or something like this and
Right.
throw away the key for 5 years. Over 20 years, if you're really decreasing it, that means there's a lot of money being invested into education and healthcare into the area. And that's something that's a difficult factor just to pull out of nowhere quickly. But if you can pull it out and see your crime rates decreasing like that, and there's a lot of markets throughout, the United States that have an increase in that. You know what I mean? A lot of markets that we might look at in the Midwest, I've seen some like that as well. And it's just you just have to stay away from that because it's something that long term, it's just not going to be a great investment. When we're buying properties, we want to buy them for 5 to 7 years, and we want to be picking markets that are going to be that we can put together a team, partner with an operating partner that's not boots on the ground there if it's not in our backyard, and that we can really build that relationship for 10, 15 years.
Yeah, no, and that's big. And you're in the syndications, right? I mean, that's one of the. Well, you talk a little. A lot of people don't know what a
Yeah.
syndication is. Would you be able to give us kind of like a high
Mhm.
level or base level what you do with a syndication, how it's utilized to pick up these apartment buildings?
Yeah, so on a what we do when we're buying larger apartment buildings is we'll put them in what we call a syndication, and what it is really there's two groups in the syndication. There are the general partners, operators, sponsors, whatever people want to call them, and then on the other hand, there's limited partners, passive investors, and when we're buying a property on I would say rule of thumb, what we're usually doing is whatever the property requires to close on it, to have the rehab budget, everything with it, the general partners are usually putting in about 20% of that, maybe 25% depending on the deal. We've gone higher than that before on deals, but it just depends, deal specific. And so the people that are the general partners on that, they are running the whole deal. Okay, they're going to be finding the markets as we just described. They're going to be finding the property, identifying the properties, identifying the neighborhoods. They're going to be building out the team with managers, the whole 9 yards, everybody else that they need, and they're going to be finding the exact property, and then they're going to be closing on it, and then they're going to be raising money from the limited partners. The only role that the limited partner has, the passive investor, is to put money into the deal, and so they do their due diligence on the group, the syndication group, the sponsor group, the operators, and then also on the specific deal. And once they've done that and they've invested their money, then what at that point is now they are a passive investor in the deal. So they have ownership in the deal. And then they're getting a percentage. The majority of the money that's made on the property is going out to the passive investors. And that is normally how it is. Now, when I was saying about the 20% or 25%, if we're into a deal, right? Because general partners will generally or should be also on the passive investor side.
Mhm.
So if I'm going to invest $100,000 into a deal myself, into a deal we're doing, that $100,000 is going to go on the passive investor side. Now I'll put it in early because I'm going to have to pay. They'll probably use that for inspections. We might use that for the 1% origination fee on our mortgage, whatever it might be.
Mhm.
But that's going to go in initially into the deal. But it's also so when someone's getting paid, one of my investors is getting paid, um, they're going to get paid at the same time I'm getting paid because I'm going to have some of that. Now, the only difference is what happens is that we have what we'll do is not to make this too complex, is what we'll have is we have what's called a preferred return, which is usually about 7 or 8%. And then we have a split on top of that. So preferred return, let's say, is 7%. And what that means is that the passive investors will make 7% per year on the deal. And then anything over that 7%, we will split that. And that split could usually be 70-30 or 80-20,
Mhm.
meaning that every $10 after that, 8 of that go to the passive investor, 2 of that goes to us, right? And that gives everybody involved in the deal. Number one, the passive investors are going to get that set amount, and it's not guaranteed. Nothing's guaranteed here, but they're going to get that set amount first, right? For them taking a risk on the investment. And then at the end, it's going to be alignment of interest because the higher we can get that return to go as the deal operators, we're going to get paid more. And with the alignment of interest of us also being right next to you on the passive side, it is in just like our full it's our full alignment of interest that our interest is to get it as the highest return possible for everybody. And that's really how the syndication model works. And it's been around for several hundred years in different models, but it's really hedge funds have been using it for decades, and private equity is something that, since we've really seen a jump up after the Jobs Act many years back, syndications have really come out into the forefront. They're not really just country club deals like it used to be
Yeah.
back in 90s, 80s, 70s, 30s, whatever it was.
Yeah, no, it's growing tremendously. I know a few other people, good friends of mine. Corey Peterson's one. He's out in Arizona
Yeah.
who does a lot, and he does a great job with it as well. No, it's something that, like, and unless you're investing and unless you're into that game, you really don't know what it is. Understand it. Great job, Eric. I appreciate that. Makes it a win-win for everybody. Really, essentially, is what it does. So
Yes.
it's super, super powerful. Now, I want to talk about maybe some of the properties you target. And my thought is, if I ever get into this, and not if I get in this game, I'm probably getting in with you. I'm probably going to invest on your side, and kind of learn a bit from you. Are you looking for like a C class building that you can make a B class building, or B that you can make an A? Or are you looking to just bring them up to maybe at a B and keep it a higher level B and just increase the cash flow? Is there any
Mm.
particular targets you have? And I guess it depends on what property you're looking at and what area you're looking at too. But is that something that goes through your head when you're looking at evaluating these properties?
Yeah, so I started out with C-class properties investing, and I think we bought our last C-class property in 2020, and we're selling that right now. Since then, we've really turned our focus to B minus, B class properties and
Mhm.
above. Really B. We don't go into A, but really B class properties. And it's something that we've seen because C class properties are great, and it's a great way to get started. Never go less than a C class property.
Right.
You just don't want to deal with it. But what we'll do is we come into a property, a B minus property, B property, whatever it is, and we want to increase obviously the profit of this property. Now, every deal could be a little different. So our first syndication deal was a major change from management, the operations of the property, and then also like a huge renovation. The deal we're selling right now, which we bought in 2020, that deal is a little different than that. It was strictly an operations deal, right? We went in there, we didn't do too much work to the properties per se. We did some renovations to the properties, and we did some interior renovations, probably 1/3 of the property. We didn't do more than that. And but it was really getting in new management, because of terrible management prior that
Mm.
really ran the property down. And so we had to fix a lot of deferred maintenance, but also that's it. So really, when we're buying a property, there's always an operations standpoint, because we're buying properties that are typically owned 10 plus years from the
Mhm.
previous owners. Okay. If anybody's ever owned property for 10 plus years that they're renting out, they're not going to be as sharp. It's just how it is. I was the same way with properties I own. They're not going to be as sharp on knowing the market, raising rents. The property's probably appreciated a whole bunch since they purchased it,
Mhm.
and they're not running it. They're running it more for ease of running it versus to the most effective and most profitable route. And that's just how it is. And that's a big thing with mom and pop investors. So what we'll do is, when we come in as a private equity firm, we will come in with our partners, and we will purchase the property. And when we are really looking, when we're doing our due diligence on property, yes, we said it's B class property. We really want to see properties built 1985 and after, or newer, and that takes away a lot of issues that could be with the properties. And we used to buy older properties. I mean, my first properties were like 1900, 1902, 1904. There's a lot of maintenance, and there's a lot of problems, even buying properties built in the 60s, because it's just the materials that were used. And there's a lot of different parts that go into that. When you're buying stuff built in the 80s and newer, it's something where a lot of the things don't have to be upgraded as much. Like your electrical's usually fine with no problems. Typically, they weren't using as poor materials, especially if you're in a better area. There's no lead, there's no asbestos, there's no aluminum wiring, stuff like this that becomes very expensive. And if it's not rectified, it can become very dangerous for people that are living there. So when we're focusing on B class properties, we're focusing on this age group, this vintage, and then we're really going in. Next step is, when we're looking at this property, we want to see comparables to it, rental comparables to the property. So we want to find another property that's close to where we are, where this subject property is, and see exactly what they're getting for rents, and then dig in more and see that. What is the condition of the units? Okay. And then that's really where you can make the decision of what we're doing, which is a value add multifamily deal. And, we might see something where the property we're looking at buying, the subject property, might be $1,000 for a bedroom, 1 bath apartment. We
Mhm.
might see a property that was built right around the same age, but it's been renovated 3 years ago, and they're getting $1,275 per month
Mhm.
on a similar unit that's been renovated. So then we look back and we go, okay, it's going to cost us $4,800 to renovate this unit. And then we know we'll put our numbers at, let's just say we're going to get $1,225, right? Just be a little bit more conservative, maybe
Yeah.
put 1,200 on there. So now we say $200 a month that we're going to make, put that into how many months for the 4,800. And then we have to add on any of the exterior maintenance repairs that have to be done. So, there's 12 roofs at this property, right? Okay, so we have to, 8 of them aren't looking great, and
Mhm.
all 12 are going to have to be done within 5 years. Okay, so we have to put away that money for 12 roofs right away, knowing exactly that we're going to have to replace all these during our whole time. We might as well just do them up front, right?
Right.
So all these different things go into it where you're working out of how much more income you can get out of the property, and then what needs to be done to the property to bring it up to the level it should be at, right? Get rid of all
Yes.
that deferred maintenance. And then really the last part is really putting in new management. And this is the thing, is if you're in an area, you're in a market, you probably already have a very good management company that you're working with. So now we can add that management company onto this property. There's 2 parts to this. Number one is that we're probably going to get a better price on management from our previous properties, and then also on this new property. Okay. So that's a huge benefit. And then the other thing too is that we're going to build that relationship more, because we're also going to have all the team members that we had access to previously on previous deals, like contractors, vendors. Now we can bring them onto this deal. And that's where we're able to get the economies of scale, get prices down a little bit from what we were paying before, because now we have more units and they
Yeah.
have more income coming in. But also, you're going to build, you're really building that team so that if there's any type of issues that happen, now you can rely more on them because you've worked with them previously versus just someone. Not that you would go through the Yellow Pages, but let's just use that example. You found someone through Yellow Pages and you're trying to have them fix stuff.
Yeah. No, makes a ton of
Yeah.
sense. And I'd say the management is got to be it's the key. It's probably one of the key
Yeah.
components, the biggest component you're going to find there. So if you're entering a new market you have never been in before, how do you guys go about finding a property management person in that area? Is there a certain process that you go through?
Yeah. So what we've on our first couple syndications we did, we found one management company after going through about 7 or 8 of them, just reviewing them, not hiring them, and we've used that management company for many years. Now what we're doing is our goal really is partnering with operators that are in markets that already have assets there. And what we'll do with them, it's usually like over a 3 or 4 year period where we will most likely invest with them passively, right? On the passive investor side of the deal, see how it works. And then we will partner with them on future deal. And that's where we're actually coming in. We're going to sign on debt. We're going to raise money for them. We're going to handle some of the asset management, which is really weekly calls with the property managers, and really put together investment reports, kind of handling a lot of the offsite type activities.
Mm.
Whereas our on the ground operations partner is really boots on the ground. We are tapping into the network they already have there, which is
Right.
great. So if they have 4 other properties there, great. So we bought a property in Dallas, November 2022, and we tapped into an operator that we know there, and literally they have over 3,000 units within like a 45-minute drive of this. They
Mm.
have their own property management company. This is exactly what we want to get involved with. We know that there's not going to be any changes in management. We know there's not going to be any issues with finding contractors because they use them for all these other units they have. So this is really kind of, you're tapping into the network and the team that's already been built. It's like passively investing with someone. You know what I mean? Where they've done a lot of the hard work, and now you're just kind of riding in on their coattails. And this way we can do it by adding that value to them, where it's like, hey, here's additional investment income, money that you can use we can buy bigger properties together. And then we will take some of these activities and some of these responsibilities off your plate. And then we'll take care of them, and actually, put together a partnership where it's a win-win for our companies, and then also for all the investors that are involved.
That makes so much sense. I never really thought about it from that perspective, but to me, that makes so much sense. And a lot of investors want to try to do everything themselves. That's always going to be a mistake. You're going to fumble and bumble. Yeah, you'll learn something along the way, but it is so much better and easier just partner with somebody who's already doing everything right in that
Mhm.
particular market, already knows all the contacts that you don't now have to make. Now you're just tapping on, yeah, you're taking some revenue away from yourself,
Mhm.
but you probably overall are adding more revenue to yourself because you're saving on all those headaches you're gonna have to deal with, and you're saving yourself the most important asset, which is time,
Yeah.
because they're going to handle everything and do that there. And then you're handling a lot of this stuff on the back end as far as the investment, bringing in different people there. So I think partnering is what I've noticed
Mm.
in the multifamily space. Partnering is something that's just done routinely, right? It seems to be the norm in a multifamily
Mm.
compared to the single family. Would you say that's true?
Yeah, yeah. It's you don't, because you can do, like you said, you can do in single family everything yourself. I mean, I
Yeah.
did it for many years. I self-managed those properties for many years myself, and I was only forced when I moved down to Florida to put third party in. But that's the problem with the larger stuff. You just can't do it. I mean, it took me many months of planning out before we did our first syndication that come to that moment where I realized that this is the only way to do it, is that you have to do the networking. You have to spend many hours finding people, evaluating them, all the stuff that has to go in, but you have to do it. And the problem is with single family is that you can get around that. But the problem is at some point you can't,
Yes.
because you need to then start bringing in people to focus on what you're doing. I mean, if you're focusing on something in your business, you're going to have someone else that's also going to be focusing on special parts of your business that you're not the best at. And it's with any successful person, there's other people there that are helping them, whether they're equity person or whether they're like a higher end employee for them. So
Yeah, no, I've always, no, when I was new investing and stuff, I was always in my own way doing
mm,
things. Right? I kind of learned that these bad habits I picked up from my uncle, just doing it yourself, and that's really not
yeah,
the best way to do it. Right? Why not learn from somebody else who has some experience and partner with them, and then you're sharing in the profits by doing that. You're taking a lot off your plate. You're
yeah,
cutting your learning curve. You're learning from them how to do it the right way rather
right.
than doing it the wrong way. Right? All these different factors that come in there. So it's brilliant. I love your model. Totally love it. So if I find something that looks pretty good and I think, hey, this could be a deal, I may reach out to you and say, hey, Charles, I think this is a deal here. Is this something we can potentially partner on? Do you do that with other investors out there? Do people bring
W-
deals to you that you look at and potentially do them together?
We do, but typically the underwriting has been done,
Yeah.
and it's something, if someone brought us something that's actually really underwrite, and it's a much different underwriting process than when you're underwriting single family. And
Yeah.
new investors are are notorious for leaving out expenses and leaving
Yes.
out line items, and they're just like, you know what I mean? I'm renting it for
So
2,000
true.
a month, and my principal interest taxes is 1,200. I'm making 800, and you're like, well, don't you ever have like a common electric bill that has to be paid? Does
Right.
somebody mow the lawn? Does oh yeah, yeah, we do that sometimes. A winter cleaning has to be done, snow removal, all this stuff. And then you're like looking at it, you're like, well, you should be underwriting the deal. Send it to me. And if it's done like that, it's something we will entertain and we can look at. If it's in one of the markets we're working at, if it's in a market that we're not part of, we're not going to do it. Because at that point, if it's 100 plus units, it makes sense for what we're doing. 100 plus units is key for us in so many senses, because the there's really a rule of thumb with what we're doing. It's really, you have 2 people per 100 units, right? 2 people on property, right? From the management company. You're going to have a leasing person, admin, something like this.
Mhm.
And then you're also going to have a handyman, right?
Right.
Per that. Maybe you'll have a part-time one. Maybe you have 125 units. You'll have a part-time person as well. But rule of thumb, that's what you're going to have full-time at that property. The problem is when you start getting too low, you start doing 30 units or 40 units. That's where I kind of need a full-time handyman person. However, I also need to have a full-time person in the office. And this is where it gets too expensive.
Yes.
So when we did deals initially like that, our first deal was really a 32 unit property. And then we bought 27 units, like in threes and fours, quads and triplexes around the 32 to get more scale. And
Mhm.
then we were able to, and that was a nightmare. But the thing though is that investors did really well on it, but it's a lot of work. Don't do that. The thing though is that portfolio properties. But the thing though is that in that scenario, now we had nearly 60 units, and now we can hire sometime full time person. They could walk to the different properties, and then we had at the 32, we had an office, and then that people could now pay their rent there. They could do stuff there, and that's where you're getting the scale. You know what I mean? Is
Yes.
with the more units. So the goal is that if you say I don't want to do syndication, I want to buy all the properties myself, and I'm going to partner with do a joint venture partnership. Oh, that's great, but just focus on the area where you're buying. Like when I bought up north, all my properties were in like 4/10 of a mile from each other, very close. I could walk between the properties if I wanted to. So it's one of those things that if you're building out your own portfolio, you don't want to do syndication. You want to start with smaller multifamilies, buy them close to each other. And then at some point, when you get sick of them and you want to put management, like a third party property management in place of them, it's going to be easier for them to take them over because their end is going to be easier. They don't have to like send some guy, 45 minutes away to some duplex you had because you know what I mean? And then you
Yes.
have the best of them right here. It's just like it's madness. So it's just one of those things that be strategic when you're buying if you're building your own portfolio and getting the real goal to like 40 units, let's say, so you
Mhm.
can hire that full-time on-site handyman, really, that's just focusing on your properties 40 hours a week. You can trust them with the keys, all that stuff, and that's really what I would say is really your goal. And it's not that much, if you're, you can, and then it's not that much per to pay them for this. And then also the other thing too is that, well, yes, you don't have the leasing person, but you can make a deal with a local real estate agent and pay them a nice fee, right? To rent them out to nice to nice, good tenants
Yep.
and in your area. And so you can make everything work. You don't have to go the syndication route if you don't want to, but just make sure that you're strategic on when you're starting to invest, what your real end goal is.
Yes, that's okay. I was gonna you already led into it. I was gonna try to get into there with the smaller apartment buildings compared to the bigger apartment buildings.
Mm.
So I have a smaller 12 unit, and like you said there, I have a property manager who's an agent, right? Who also does
Mhm.
other things, and we have three different people that are handyman and slash HVAC people slash plumbers, electricians separately, to go as needed, and that's fairly easy to manage. I don't need a full time person, right? I
Mhm.
definitely don't need a full time person yet. So you're right, getting into that 32 to 40 unit. I got a 12 unit, I got a 5 unit. Maybe if I add a couple more where I get to that point where I'll do that. But so my next question would be, would you recommend people to get into the smaller one to learn and two maybe to grow it, fix it, repair it, raise rents, and then move on to a bigger project
Ah.
from there? Is that something you recommend or no?
Those are great questions. So the first one is it figure out what your goal is. If you're most people don't want to be a landlord, right? I mean, I
Yeah.
think everybody I grew up with when I told them my dad was a landlord, they're like, this is like the worst thing I've ever heard of. But then it's my dad would always we'd collect rent and he'd pick up rent from superintendents and it was all residual. And we could go on vacation for road trips for long periods of time and no one else could do that. So it's just one of those things that what is your end goal? Is your end goal like getting passive income and that's it? And I want some tax benefits and I really don't like walking properties or doing anything with the real estate. I just want the benefits. Then it's like passive investing is your thing and spend all your time in your vocation right now and build that up and invest into different deals with different operators. Um, if you actually want to be an active real estate investor and maybe do something like what we're doing now, whatever level you'd like to do it at, you before you start taking money from investors, from getting into partnerships, do a deal by yourself. Whether
Yeah.
that's I would say like a duplex. I would say really like a triplex, quad.
Mhm.
You have separate tenants there. It's going to take a little bit of the heat off of you, right? Just because you're just not going to have one person paying you. Now you're going to have two or three. Hopefully, you have some garages behind it that you can rent to
Yeah.
people as well, and you got some income streams coming in there, right? So thing
Mhm.
doesn't go to zero when someone says they're not going to pay you, right?
Right.
And that really teaches you exactly all the parts of it. Buy it closer to where you live. Preferably, you could do a house hack, which is kind of how I started. They didn't even have the name back then, but it was really just live in one of the units, rent out the other two.
Yep.
That way, you're getting really good deals. I'm sorry, you're getting really good debt, and then
Mm.
you're learning to be a landlord with like one or two tenants, and you're learning like leases and evictions, hopefully not evictions right away, but you will
Right.
at some point. And you'll learn all these different parts. You'll find local handymen to work with you and stuff. And at your point, I mean, you're not able to hire someone full time. So you make a contract with someone and, make a deal with someone, not a contract, but you make contact with someone and then really, hey, every Friday, last of the month or something like this, I'd like to give you like one afternoon a month to fix things at the property. You know what I mean?
Mhm.
So I'd make
Mhm.
a list of stuff that doesn't have to be fixed right away, but it should be. You know what I mean? This is loose. That has to be replaced. This fixture doesn't look, it doesn't turn on how it's supposed to. These stuff has to be done. And you give him a list of stuff and he goes and does it for you. And at that point, that's how you're managing properties at that point. And the more units you have, the better relationship you're going to have with them, and the more they're going to stay with you. Because if you're just giving them a little bit of work, they'll, next thing you know, they got a full-time job as like a union electrician or something, and it's nothing that you can compete with. So it's just if you give them a little bit of deal and then they're working with you and stuff like this, that's where you really build that relationship. And that's what I would say. If you actually want to get in on the active side, I would start with smaller stuff. Do it with your own money first. If you don't have money, get money first from your own money.
Mhm.
And don't take money from investors yet. Build out, make sure you understand and you have a provable business model.
Mhm.
And then when future deals are, then you can buy them. On that first deal, you can get the long-term debt, right? 30-year debt, because you're going to buy it triplex or quad.
Mhm.
You have some reserve money, so have an idea of what it's going to cost. Make sure you go into property that doesn't have that much work to do. Number one, right? Buy
Mhm.
properties that are very light rehabs to start. Don't get into heavy. There's many years down the road that you can get into properties that are very heavy rehabs. Don't do it initially. Just get something that there's a little bit of work, because it will be work. No matter what property you buy, no matter what they tell you, it's turnkey means that still costs money to put money in there. You know what I mean? There's still going to be
Yes.
stuff that you're going to want to do. So have all that money lined up to the best of your ability. If you don't know, then just have like a reserve fund, in a savings account that you can access to get the property up and running. Get it rented out. And that's what I would say in your first time is, if you have all those things, it's really difficult to lose money. And then just make sure you're buying in areas that are, that are good. Don't buy in areas, if you're questionable areas, don't buy in them. Buy areas, and there's lots of different, like, justice maps. You go on that, it tells you exactly the different, how the neighborhoods change. It's all done. You know what I mean? They
Yes.
categorize it for you. You know exactly where the train tracks are if you're not even there. So
Yeah. And the biggest advantage for people out there who do the single family compared to the single family is sexy, do your fix and flips, do your buy and holds and stuff. But if you're doing enough flips or you're doing enough wholesale deals, you're paying a lot of taxes to the
yeah.
federal government. If you do a building or two, these multifamily, you're not paying any more federal income
Yeah.
taxes. Let's talk a little bit about that with
Mm-hmm.
cost segregation analysis for accelerated depreciation, which of course is changing a little bit now, right? I think it's down 80% this year, and I think it scales down moving forward. Talk a little bit about that, how one, it's saved on taxes, and kind of what the process is for cost segregation
Yeah.
analysis.
One thing, just before we get into that, Paul, what you mentioned was that when I bought my first two properties, I bought them from some of the largest landlords in the city that I was involved with, right? And they all had their own rental portfolio. They had
Mhm.
people on their payroll, like one or two contractors themselves or handymen that were doing flips. So they did everything. They did
Yeah.
flips, and then that worked the best because whatever that day, whenever something has to be fixed, they just, hey, on your way home, leave early from this flip site, go over there, fix this, and everything works hand in hand. So also the last part, which I imagine they were aware of, was the taxes. So a lot of people that are active in the real estate, they also are passive, except for real estate agents. For some reason, a lot of them do not invest in real estate, which I don't know why.
Yeah.
But that's a whole different, well, so many different podcasts on the road for
Totally.
that. But when we're getting into cost segregation, so taxes are a huge thing. And we have this great thing with real estate, and we're just going to talk about residential. So that could be multifamily apartment buildings. We're not going to talk about like office buildings or anything like that because it's a different depreciation schedule. So you are able to depreciate your property, and now we have with with the Jobs Act, with Trump, was Trump's or whatever, well, the last
Trump's.
one he did in 2017, right?
Yeah.
So I just call it the Trump tax ones. It was like, you can now, instead of having this property depreciate over 27 and a half years, of course it's the IRS, it wouldn't be like a regular full year. You can get all that depreciation in your first year, right? That used to be up to 2022.
Yeah.
2023 on, now that's going to 80%. So now
Yes.
you can pull 80% of your depreciation in the first year, and then it's going to go to, I think, 60 and 40 and something like this. It's a step down to whatever it was. I'm not sure how far it goes down. Talk to your accountant on that. But the first thing is that with these cost segregation studies, what it does is that these firms are going to go pretty much into your property, and they're going to itemize everything. So 27 and a half years, that's what they say stuff will last for. Well, if you're in Florida, your roof ain't lasting 27 and a half years if you have an asphalt roof. And I'm telling you right now, I've never had a faucet in a rental property that's lasted more than 15 years, right? It's just not how it is. So they're going to go in there and tell you that this carpet's going to last on the stairs here is going to last this, and these faucets are going to last 7 years, and this is going to last this toilet's going to last this. And then they figure out as much depreciation, and they can really speed up, and that really adds to how much of the depreciation you can take initially. and because it tells you the real time frame, a lifeline of what those properties are, the lifetime. And so that cost segregation is a huge benefit, because now, coming back to what this is all about, is that um, professional real estate professionals, if that's what you're categorized by the IRS as, um, that means that you're now able to take this against your active income. So that depreciation can really go right off of your active income. So if you made $100,000 flipping properties, and say you invested into one of my syndications, or you bought your own property, whatever it might be, and let's say you were able to get $25,000 in depreciation. So when you're doing your taxes, that's not going to show as 75. Okay. And, there's been a lot of tax changes. It used to be for anybody up until like the 80s, I think 86. And then they got changed. And then back in the 90s, I think it came back again. And this was only for real estate professionals. So you have to talk to your real estate. I mean, you have to talk to your CPA and make sure, figure out how you can be, or you can just Google it. You learn some information, but also always talk to an accountant about how you're going to, if it's possible for you. And really, what the main thing is that 750 hours a year have to be spent in a real estate trade. And then the other part is that you have to spend more time in real estate than in any other business. And there's a lot of other particulars, but those are the main ones that really keep people out or open the door to possibly this working for them. And with this depreciation, it allows you to obviously push back these taxes, decrease your taxes. And with
Mhm.
real estate, with our 1031s and all this stuff, there's not really tax free. It's really deferral. So the problem happens, though, is that when you want to sell that property, not the problem, but potential problem could be when you want to sell a property, or when, say, we're selling that property for you in 5 years on the road that you've invested into with us, now that depreciation is going to be recaptured plus your gain. Okay.
Mhm.
So it means that now you have to, if you got depreciated $25,000 and you made $25,000, well, now it's showing that you really made $50,000. So you have to reinvest that at that point in time. So it's a deferral strategy, but in our high inflation, which it still is, maybe not as high as it used to be, but environment, I mean, every day that you can push out your taxes, I mean, it's just getting less and less expensive, even if you have to pay those taxes in 5 years or when that property sells. But just knowing about this when you're investing, and it makes it very important about, I wouldn't let buy property because of just taxes. I think it's an extra benefit. You should buy good properties in growing
Yes.
markets that are going to appreciate and going to provide cash flow for you and your investors. But the tax portion of it is something that every investor, especially if you're in any type of active investing, so
Mhm.
wholesaling or anything, you know what I mean? If you're active, if you're wholesaling, you're flipping, whatever you might be doing, you're an agent. Now what you're able to do is investing into real estate, where you're able to get the depreciation is a game changer. And then the last thing too is that if you're flipped, it's like, you're holding these properties for more than a year. So now it's long-term capital gains. It's not your short-term, which means you're avoiding a lot of taxes there to the federal government.
Great point. I mean,
You know?
that's a huge point right there. Getting back to your 5 to 7 year time frame,
Yeah.
you say that, are you selling the property at 5 to 7 years? Or are you refinancing and paying your
Mm.
partners out on that one? Which are you doing with your model?
So typically, well, over the last like 3 or 4 years, they've all been going about 3 years,
Okay.
and which will not continue, as we were talking about. I mean,
Right.
it's just where we are in the market. So we tell investors all the time, 5 to 7 years. 5 to 7 years, we're typically going to sell the property.
Mhm.
Um, we've refinanced before and then given money back out to investors. It depends on how you're initially financing the property. We have a property right now that is outside of Atlanta, 157 units. It's our best performing property. It's fantastic.
Mhm.
And we have floating variable debt on it, right, with a rate cap on it.
Mhm.
And now we're coming up with, we got about another year on that. So now we're going to figure out if we're going to refinance it, which would be great. And now we can provide money back to our investors, part of their return back to the investors and still own the property. Or are we going to look to sell it? So it depends on where we are in the market, and it depends
Yeah.
on exactly what it is, for the property where we are. And I just, if you're going to hold a property, when you start getting into commercial multifamily loans, commercial loans in general, there's a lot more fees than what you're dealing with your 1 to 4, and there's a lot of prepayment penalties. So
Yes.
everybody always looks in mortgages as, the rate. It's all it is. It's the rate, right?
Mhm.
When you're talking residential, when you get into commercial, 5+ multifamily properties, this is where there's prepayment penalties that can be extremely hefty. This
Yeah.
is where there are terms that can range from 3 years to 40 years, 40 years, depending on the product that you're using. These are where there could be variable debt, right? Which obviously we know back in '08 that was a big problem, but it's not as popular, let's say, right now for
Yeah.
people. So it's not a big thing, but it is a big thing on multifamily in the commercial space. So just kind of putting all these pieces when you're looking at debt or when you're looking to invest into a property, make sure that you're aware of all these different facets of it. Because if you're doing your numbers out at that, you're going to get, you're buying a 10-unit apartment building and you're going to get 30-year debt. It's probably not going to happen. You know what I mean?
Yes.
I know one bank that gave me 25 years, but most banks are going to do 5 or 10
Yeah.
years on that term. And then at 5 or 10 years, even though it's amortized over, let's say, 25 years, right? So it's going to be a shorter amortization period with that, which means that your payments can be a lot higher because you're paying more principal.
Mhm.
Um, you know, but 5 or 10 years, what are you going to do with that? You know what I mean? So are you going to roll that into another property? Okay, well, then it's going to be another rate. Are you going to, roll it into another loan? It's going to be another rate. If the lending environment has seized up at that point, then there's a problem with that because now you have to sell the property, right? Or
Yes.
find some other, not as convenient or competitively priced solution to refinance into. So that's the key, is that when you're getting into something like this, maybe a 10-year debt, and if you're working with local banks, regional banks, which is really who is the lifeblood of these smaller, let's just say
Mhm.
smaller multifamily or multifamily investment properties, where you're talking, a few $100,000 all the way up to 5 million or $10 million, where they really focus on in their local neighborhoods, investing in and funding deals for. That is, you just have to have more of a game plan. And that's why it's not something for the first time investor, I would say. That's why it's important, why I said before, is dealing with the duplexes, triplexes, quads, so you can
Yes.
get that fixed debt 30 years. It's much more easier to swallow and understand and easier to do your numbers. Whereas you might have something where you're like, well, I don't know where interest rates are going to be. Well, no one really has an idea where interest rates are going to be per se. The key, though, is just how much value can I add to the property? Because the more value I add to it when I go to refinance it, that's what gives you the buffer, right?
Yeah.
If we're getting into a 2008 type thing and you go to try to refinance at 80% loan to value, you might as well just lost the property, right? Even though
Yeah.
you still are, above water on the property. Now you go to them and you tell them it's 50% loan to value, people are going to return your calls, right? To
Yeah.
see if they can
True.
finance it, right? When I was trying to refinance commercial properties in 2010, I literally had a bank that I'd worked with, not with real estate per se, but with other businesses for several years. You know what I mean?
Mhm.
Several years I've worked with them. And they literally were going to give me 20% loan to cost. And
Oh.
I just bought the property for 28 cents on the dollar, and I put it all, there's no mortgage on it, right? So
Mhm.
this property was literally going to be a third, all renovated, one third of what it sold for like the year before, maybe, something like this. And there was no lending on it. And
Yeah.
that's when the prices were so, you were buying back then too. I mean, it's just like
Yes.
this, this is what happens when it seizes up. You don't want to be in that point. You know what I mean? So
Yeah.
it's just like, I, just something you have to know. And commercial is a whole nother animal for a more advanced investor. It's like getting into big renovation projects. It's not something you should do on your first investment.
Yeah, it's a great point here. The commercial or the real estate investing, that the credit market froze up in 2009, 10, 11. So it was really tough to get financing for literally anything at that point there. Um, going to my 12 unit building, I can get 30-year financing on that. They do have prepayment penalties. So this is where I'm really leery. Like what I do here, it's non-recourse, which is great, right? But it does have their prepayment penalties. If I go to move this or sell this, it becomes kind of
Mm,
a pain in my butt here. So I'm debating on what to do with this property. I don't want to sell it because I did the cost segregation analysis. I'm getting the great depreciation, which saves me on my regular flips and everything that I'm doing. So I'd prefer to keep it full time now. I'm thinking about talking to the local lender there in Casper and see if they'll do something. Again, they're going to be a 5-year fix, like you said, to amortized over 25 years, and then it'll reset. And 5 years down the road, what are rates looking like? So it's
no,
it's a gamble. I'm debating on what to do with it. Maybe I just decide I'm going to keep it for the whole prepayment penalty time.
yeah,
And I got 30-year fixed at it. Cash flows marvelously. So maybe I should just go ahead and do that. But these are things that are going through my mind,
no,
and like I'm sure go through your mind on every single different property there.
yeah.
So when you're selling your properties, do you do a 1031 exchange if you're doing that, or do you bite the bullet and pay the taxes? How do you guys generally do it?
1031 on a syndication is very difficult.
It
I mean,
is.
1031 on anything is difficult,
It's hard.
and
Yeah.
yeah, there's a lot of moving parts, and it just doesn't end when you buy that new property. It continues until something happens. You pay taxes or you pass away, right? So um, what we usually will do is we'll sell. We give an open window to our investors and let them know, like, so we're selling something that's going to be sold. I don't know, the first week of July, let's just say, in 2023. So with this being said, is that they now have the rest of the year to place as capital, okay? Or if they
Mhm.
did any investing prior to this during the year, that can assist them with taking down on their passive gains. Okay. And for myself too. I mean, I have money that's coming out of this as well. So
Yeah.
when I'm investing, I have now the rest of the year, whether we're going to do another deal, as general partners through Harborside, or am I going to passively invest this into someone else's deal? Because I do a lot of passive investing in other people's deals as well. And that's where, you can keep this open, and that way it'll defer the majority of my taxes. You know what I mean? That I would
Mhm.
have made on this. And my thing is, you defer it, and even if you're paying something during it, it is what it is. But the majority
Yeah.
of it, if it gets kicked down, the can gets kicked down the road. Um, that's where you're really saving a lot of your money, and then the inflation just eats away at it. You know what I
Yeah.
mean? So it's just people like complain about inflation, and then it's not that bad if you're like you get a loan that you're like trying to
Totally.
with yeah. So but yeah, no, it's one thing also with the like what you're talking about with the prepayment penalties is that you have to see exactly what that prepayment penalty is. So when people are looking at it, there's some that get very technical and have to run off of what the U.S. Treasury is.
You're
And
right.
if you're in a decreasing interest environment, which we might come to, who knows, next
Right.
year, um, then it becomes very expensive because you have to maintain their yield on that, right?
Mm.
But if
Mhm.
it's increasing, they're like, oh yeah, get rid of your debt because I can put it back out on the street for a higher amount, right?
Make more.
Yeah.
Yeah.
But the other thing is I had a partner years back that explained this to me, and he would say, like, the refinancing in 10 years, we talk about it here at the show, and it's probably in a negative light where it's not 30 years. But he would always say it as a huge positive because he would say, like, he would deal with other real estate investors, and every 10 years they go to a commercial property, they refinance it out, maybe 8 years, whatever, and they're taking out like several $100,000 out of that property while still
Mhm.
keeping their loan value low, and then they just go on upon their day. There's no tax when you refinance a property. There's no taxes,
Right.
so it really forces the investor to pull equity out of their property. And you can get
Mhm.
really aggressive with it. But if you're a smart, old school type investor and you're going to keep that around like a 60% loan to value, it forces you to go in there and pull out some money. And now you can do it. And he was like, just telling me that he would work for years with people, other developers and stuff that would do this and on properties that they owned, and they would build it. You know what I mean? They have all this depreciation then, and then they would just like use that as like a piggy bank every 7 years, just pulling out money out of it.
Mhm.
So there's also benefits to it as well. You know what I mean? There's
Yes.
costs, there's a little extra hassle, but there's also benefits to it to the investor.
Yeah. No, no, I completely agree. Look, it's it's a good thing to look at. I mean, it's a pain in the butt. Nobody wants to pay taxes and
Yeah.
all that kind of thing, but there's so many different positive. It's like splitting hairs, right?
Yes. Yes.
It's a bugger. Listen, I know we got a hard stop coming up here in about 7 minutes or so, so I want to give you time. I know you're offering a free passive investing guide. So I want you to talk a little bit about that. And also, I do have a streaming here where people can contact you or release your website and stuff. But if you want to give any more information where people can reach you, contact you, go ahead and pass forward that information here.
Yeah, thanks. So thank you so much for having me on, Paul. Our company is Harborside Partners, harborsidepartners.com, and you can go to it. We have a free guide for passive investing. We have a weekly newsletter we put out that's pretty much links I put together of articles that I feel people would be interested in with the economy, with real estate, with commercial real estate, all different parts of it. Whatever I think was interesting, we will put out there in a newsletter. And if you're interested in investing with us passively, feel free to set up a call with someone on our team. And then lastly, if you're interested in being an active investor, we have tons of resources. I have my own podcast. Paul was on it, where we talk to the best real estate investors and people out there. And hopefully you can learn some more about from our interviews. And then I do a weekend segment that is just about strategy, and it's only a few minutes long, where I go through all these different prepayment penalties and all these other terms that we've been throwing around here, recourse and non-recourse debt. So you can learn more about getting into larger properties with us. And I'd love to hopefully speak to you.
And look, there's a lot of people out there who are debating, do I get into, a good friend of mine's in the same boat here, and he's a private lender right now. Do I jump into the real estate game? Do I just lend to somebody like you looking at investing with Harborside? And look, I think if you don't know what you're doing, what you want to do, if you don't want to be too active, I would definitely recommend investing with somebody like Harborside, where one, you're going to be passive, right? You're going to get some of the benefits, a lot of the benefits, right, of investing in there. You get tax benefits as well, which is huge. And there's not a whole lot of ways you can do that. You can't really do that investing in a stock market, right? So real estate is still the best way, still the most tax advantaged asset. So definitely reach out to Charles and his team about that for anybody looking at investing, and especially if you want to earn passively. There's not much of a better, safer way to do it than investing in real estate. Charles, thank you so much for your time here. I really appreciate having on. So much great information you gave here for our listeners. I really, really appreciate it so much.
Thanks a lot for having me on today, Paul.
You got it. And we'll have you on here again. Let's definitely plan something the next 6 months or so to bring you back on here. We'll do another update. We'll see what's going on with the markets. Maybe we'll talk interest rates. We'll talk all kinds of different stuff.
Sounds great.
All righty. Thank you.